We now have a very special guest with us for the last half hour today, the founder of the world's biggest bond fund, PIMCO's Bill Gross. He's here with us live in person in New York. Last night you won the Lifetime Achievement Award from Institutional Investor. Congratulations.
Thank you very much. It's nice to be here.
It's nice to talk to you in person instead of remote from California. I don't know, maybe you brought some sort of calming effect to the markets. I mean, we're hitting this $14 trillion debt ceiling today, and the bond market seemingly doesn't care.
Well, Secretary Geithner has given some wiggle room, as we know, and it perhaps is in August, and to some extent, as Republicans might wonder, it may be later than that, but it's a short time ahead, and it should be taken seriously in terms of the United States' credibility, their status as the reserve currency, and their ability to lead financially going forward. So it's no joking matter, and it should be resolved quickly.
Do you think that it was politically imprudent to allow that wiggle room until August, saying, oh, we've got the emergency funding in place until then?
Well, perhaps. I'm sure he'd want it back in terms of the first line in the sand and now the second, supposedly. Right. But I truly think that the second line in the sand is fairly firm. And to the extent from that point forward, it becomes a question of expenditures versus interest on debt and the reissuance of debt. To my way of thinking, it's critical that the latter category be maintained in terms of its reputation, its solvency, its reputation going forward.
Yeah, and you truly do see those as in jeopardy. This is more than politics at this point?
Yeah, I think so. I mean, the ability to make good on your debt is a long-standing policy of the United States. You know, some would argue in the early 30s, going off of the gold standard, so to speak, that was a default, but really the United States has never done it, and other countries have, and we are the reserve currency. We are the most liquid market and fungible market in the world, and to put that in jeopardy would probably jeopardize the status first of all, in terms of the dollar. The dollar would decline rapidly in our view, and the bond market wouldn't do well either. And stocks would follow. But it's mainly the dollar through which financial transactions are taking place on a minute-to-minute basis, and the reputation of the United States as a reserve currency that stands behind that.
I want to ask you about a big contrarian bet that you were credited with, but I think there's some confusion around. Are you or are you not short U.S. Treasuries? We
are not. To a certain extent, it may be our fault because we have a category in terms of a monthly release that we utilize, and it's called Treasury or Treasury-related securities.
Right.
It could be treasuries, it could be agencies, it could be swaps, which sophisticated bond investors know are entirely different from treasuries. And so to the extent that it shows up as a short, then it's almost entirely been in the swap category as opposed to the treasuries. The total return fund, PIMCO itself, has had tens of billions of dollars worth of treasuries, to some extent in short-term treasuries and bills and overnight collateralized repo, but it's never been a question of PIMCO in terms of the Treasury's reputation, the Treasury's potential to default. It's always been a question of value in terms of interest rates relative to other alternatives. Yield
just wasn't worth the investment. So that 3% of the total return portfolio that was credited as being negative U.S. debt, that was not a position on U.S. debt. That was actually more just swaps.
Related, correct. And that, to some extent, speaks to a durational statement, to the extent that you're selling swaps and basically reducing the duration of your portfolio. It does speak to a more defensive position because of the valuation of treasuries, agencies, and swaps. And yes, would it have been better over the past 2 months to have participated in the 50 basis point rally? Yes, it would, but I would point out that PIMCO's done really well. I mean, our total return fund, as evidenced by your numbers just over the weekend, put us in the 77th percentile for the year, share of all bond managers. And so would we have preferred to have owned a few more treasuries? Yes. But we're doing very well, thank you. And PIMCO's having a good year.
Well, Morgan Stanley and Goldman Sachs, they looked at that 50 basis point rally, and that was enough to get them to at least be neutral, if not no longer bearish on bonds. You say you could have rather, but you're not going to change your position at this point.
No, I think you have to look at it from the standpoint of, yes, the economy going forward and what inflation is going to be. To the extent that the economy slows and inflation comes down, that obviously supports the Treasury market. But Treasuries, as we know, for the past several years have been supported artificially by QE1 and QE2, and as well by Chinese and other large reserve holders. I mean, half of the U.S. Treasury stock is owned by either the Federal Reserve or foreign interests. And that, to a certain extent, suggests an artificiality to yield levels. We don't know exactly how much. The Federal Reserve of New York has estimated perhaps 50 to 100 basis points of under-yielding, overpriced valuation from these programs in combination. And if that's the case, it simply means that investors are receiving less than they should,
right,
and they should look for alternatives.
These conversations that are underway in Brussels right now about possibly adding to Greece's bailout package, nailing down what happens in Portugal's package, do you think the IMF can still do its job without their chief at the table?
Oh, I think they can. Institutions move on, and this institution certainly has a long history of providing policy, appropriate policies for struggling emerging markets, and now for Euroland at the periphery. So of course they can. The institution will live on beyond the man, so to speak.
Now, should Greece get more than $155 billion in aid?
Hopefully they don't need more than 150, and of course Portugal and Ireland are in line for close to 100 billion plus or minus themselves. So it becomes a package of 300 to 400 billion euros in potential financing. Basically, most of it hasn't been granted yet, but it becomes a question now, Margaret, of solvency as opposed to liquidity. The liquidity's been bolstered by the ECB over the past 12 to 24 months. Now it's a solvency question, and obviously investors and countries themselves, politicians, Merkel and others, are asking themselves whether or not it's fair and appropriate to extend additional funding for these countries which have abused their privilege, so to speak, at the borrowing line. That's a decision that they have to make. We suggest going forward that Greece is insolvent, and that at some point the cannot be kicked down the road any further. It may be sooner now rather than later. What that means, I'm not sure in terms of months or even in terms of a small amount of years, but definitely Greece is insolvent and needs funding from the FSF and a lifeline, but ultimately I think debt holders will have to bear some of the burden as well.
Your co-CEO, Mohamed Al-Arian, said that you do expect one restructuring default in Europe this year. Would it be Greece?
Well, certainly. They're the number one candidate. Ireland and Portugal have similar situations in terms of high debt to GDP, and similar situations in terms of negative growth looking forward, which is the ultimate problem. I mean, Rogoff and Reinhardt pointed out in their wonderful book, it's different this time, that economic growth is a fundamental way that countries get out from under. And so, a debt holder should be looking to analyze whether or not a country can grow again. And it appears that Greece, even with the stringent, or maybe because of the stringent fiscal measures that they've implemented, basically can't get above the line in terms of real growth. And that ultimately means that since they're paying 5, 6, 7% on their debt through the ECB and the EFSF.
And that was already reduced. Yeah.
Right, and that's been reduced. But they have to be able to grow above that, and either nominally or in real terms, in order to pay back that debt and to stop the deficit and the debt levels from increasing as a percentage of GDP. And it appears that they can't do that.
I want to talk about what's happening here at home, but we got to take a break. Before I do that, is Mohamed El-Erian staying at PIMCO? Because the Wall Street Journal was saying he might be taking it over at the IMF.
Oh goodness, no. Mohamed is a best friend of mine, firmly committed for the next 20 years. He says he hopes that I outlast him, but I'm sure he's going to be there in 2031. Okay. I'm not sure about myself.
Well, you sound contractually confident there, but it was good water cooler speculation at a minimum. We talk about the end of quantitative easing at the end of June, and it seems like the markets aren't as concerned as they were last time we saw the Fed take a step back with the end of purchases of mortgage-backed securities. What happens to the credit markets when we hit end of June?
Well, it is a large question that even the Fed, I'm sure, doesn't really know, and PIMCO has question marks too. We would simply suggest that since the Fed's been buying 70 to 75% of all of the treasuries that have been offered over the past year to year and a half, that it's a legitimate question to ask who will buy them and at what yield. We simply think that Treasury yields have been artificially repressed, not only by QE1 and QE2, but by the policy rate. I mean, the policy rate at 25 basis points Fed funds, it has been there for over 2 years now, and to the extent that Fed officials, Bernanke and others, Yellen, suggest that it will remain there for the next 6 to 12 months, then that becomes a follow-on to QE2. What we sense is going to happen is that language will dominate policy going forward, and that investors, will take comfort from an increasing amount of language that suggests an extended period of time.
Well, the majority of those surveyed by Bloomberg say that by the end of the year, you're going to see rates on the 10-year up at like 3.8%, getting close to that 4% level you told me a while ago. Right. Would make them attractive to you again. Right. We're not even talking about the Fed selling the amount of treasuries that they've purchased at this point. I mean, have you forecasted that? Where do you expect the rate to be?
Well, we think 10-year treasuries will be higher in yield. I mean, now they're around 3.18%. We suspect still that 4% is a beginning level of attraction going forward. I mean,
but more than a year out.
I think so. I think that would be logical to expect, and it would be dependent again upon the extended period of time language that we're going to see after June 30th. If the Fed continues to suggest that unemployment is a priority and inflation is contained, then you can expect Fed funds to stay at 25 basis points, and that's a very significant anchor for 2s and for 5s and even for 10s. So follow the policy language going forward. Expect QE2 to end, and that QE3 probably will take the form of language as opposed to actual purchases of treasuries going forward.
And that language, transitory, the key word in there when it comes to inflation?
Transitory, yes. The difference between core and headline, we favor headline as opposed to core. And some Fed officials like Bullard and others have basically suggested that headline is what the Fed really focuses on, and that core is only a reflection of where they think headline is headed, so to speak. We think otherwise. We think that headline has been influenced and will continue to be influenced by commodity-based decisions from countries in the developing as opposed to the developed world. And as long as that demand continues, you can expect a continuing divergence between core and headline. But the Fed suggests otherwise.
Bill, it's so great talking to you in person.
Thank you. It's wonderful to be here and to see you.
And congratulations on the award.
Thank you very much.
Thanks so much for talking to us.